Hello, everyone, and welcome back to TradeFinder Live. My name is Zach. I'm one of the team here at Elliott Wave Options. Most of you are likely familiar with my voice by now, but if you're new to us or just joining for the first time, welcome. It's great to have you on board. We have some housekeeping details about the session we have to cover, and then we get into the good stuff. So first and foremost, this is our live disclosure disclaimer agreement. The main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. We have this available on our website, so please feel free to read it in detail there at any time or take a screenshot of it now if you like, but that's the main point to take away from it. Most of us, again, are probably familiar with this process. Go ahead and take a minute to review just in case once we get to the Q&A portion. Other than that, I'm just very excited to get into this session and have all the time with Rob as we can. So the Fed speak seemed to spook the market. So we'll see what that what Rob has to say on that comment, and we'll get into the webinar right now. So enough of my rambling on. Let's introduce the man of the hour, Mr. Rob Roy.
Hi, everyone, and welcome to this week's TradeFinder Live. As Zach mentioned, there was some Fed speak today that was from Fed Governor Waller, who came out and said, don't get too excited about the whole rate cut thing. Yeah, we're likely to cut rates this year, but probably not what the market is expecting, is basically a nutshell of what he said. And that sent the markets significantly in the opposite direction of where a lot of people want them to go, which is to the upside, obviously. So we'll get into that here in a second. But when we take a look at the chart, you can see that, and here's the video. There's my face still in the mountains, but it's awfully cold up here. So probably about time to start thinking about heading back to Florida, where it's cool, but not cold. So when we take a look at the chart, you can see we do have a doji today, which is really interesting to see what happens in tomorrow's trade. How often do I say that? It'll be interesting to see what happens tomorrow. But we've talked about the double top. We talked about it in the weekend update and last week as well with the move right up here towards the 480 level. We did make a slight new high from those December highs, so the wave 3 moved over, but a little bit of a tick down today. And again, that was on Waller's comments. And what was really interesting, when we move over and look at the 10-year, the TNX, you can see that we had a bit of a bounce to the upside. I've been saying that I don't really see the scenario for that kind of a move to the upside in rates. But a little bit of a bounce today. We had this big significant downward move, and I think we're just kind of chopping back and forth since then. I still don't think that we're going to have anything that could create that kind of a move up in rates. I just don't see it, not with the economic data that's coming out. And I do feel like the economic data is going to begin to weaken. So I don't think that's going to generate that kind of move in rates. Just that's all we got out of. He is a voting member of the FOMC, Fed Governor Waller. So when he speaks, or when any of the voting members speak, it does carry a little bit of weight. But we didn't even take out the high here that goes back to the 5th of January. So just a little bit of a bounce up in rates. There was a more significant move up in the dollar, though, as you can see, and that's obviously backed on rates. So we did finally break that 38.2% fib corrective level where the wave 4 was. Moved up here, but was still only a 43% correction. So still a well-formed 5-wave to the downside pattern. Perhaps the wave 4 goes up to 50% correction. Up to 61.8, as you know, still keeps a really well-formed 5-wave pattern in place. So we could move down at any time in the dollar, and where the wave 5 is forecast to be, and this is a tap box here, time and price projection. So that's based on where this 4 is labeled, that if that 4 were to hold here, this is where you could expect the 5 to find a bottom. And as I've talked to you all about a few times now, as long as the dollar stays above 96, which is going back a ways, that I think is constructive for the markets. So anywhere between 96 and 107, I think is kind of the sweet spot for the market. So I don't see the dollar affecting things too much. More on the rate side of things, but once again, even with those comments today from Fed Governor Waller trying to calm things down a bit, I mean, we've gotten to the point where there were even 7 rate cuts this year talked about. The market is expecting a rate cut in March. I don't know about that. I'm not sure we're going to see a rate cut that quick. As I've said numerous times as well, I feel like the Fed is going to be late to the party here on the rate cuts. I do think we'll get rate cuts this year, but I don't think we'll get them as early or as many as what the market is talking about. So how's that going to affect the market? Well, that should bring us in for more volatility and choppy markets. And speaking of volatility, let's go ahead and look at the VIX, which did get a little bit of move to the upside today. We talked about this level down here around 13, where we've been for quite some time, just kind of hanging around in that area and wondering if this 5-wave pattern would play out where we could go lower than the 12 level on the VIX. And all we've done is kind of stay in this range where we've been in for the past couple of months, basically between 13 and 15, call it, on the VIX. If you want to get real technical, you can go down to 12 there on those lows in December. But once again, this is for the holiday time when nobody's trading anyway. It's typically a lower volatility time frame. So a little bit of a tiny trading range here. The VIX will break out. Is it going to break to the upside? I mean, we could go up a ways here on the wave 4 and still keep this pattern in place. But if we're going to go as low as potential down there on the wave 5, I think we have to break that 12 level. And I'm not sure we're going to see that in the near future. We'll keep an eye on the economic data and see how that plays out. The last CPI report was slightly hotter than expected on the headline number, but in line on the core, which is energy. As you all know, oil has not been participating to the upside here, which kind of plays into the consumer, I think. Is that a leading indicator? I'm not sure oil is a leading indicator, but it's certainly a reflection of the consumer, travel, etc. And oil just can't seem to grab a significant bid and keep going. So without that, the core CPI number is probably going to stay in line. But even without it, it was just a touch higher than expected. It wasn't anything significant. So I do feel like we may see more than just this whole soft landing thing. I've been saying I feel like we might have a moderate recession. I'm not calling for anything significant. Some of you on our YouTube video have posted you think it's going to get really bad. Some have even used that D word, depression. I don't see that. But I do feel like it's going to be a little bit more of a recession, perhaps, than the market is pricing in. So maybe the market needs a little bit of time to rest and go back and forth on this level. I wouldn't be surprised to see us test back down to this 460 level. In fact, I think that would be healthy to see a move down towards 460. If we hang around in there a bit and can hold 460, I think that's constructive for the market as well. Now, if we do break above 480 with a follow through day, then this wave three is likely to continue higher. But if you have more Fed governors coming out in the vein that Governor Waller did today, I'm not sure I see that catalyst either. So I feel like we're going to have some choppiness is the end game here. We're going to have some choppiness in the market, some choppiness in the VIX, choppiness in interest rates, etc. I just don't feel like we're going to see anything of significance. I think that big run has happened. Now, if we break above 480 with a follow-through day, well, then the shorts will be forced to cover, and we might get a couple of good spikes to the upside. But we got to do that first, and we haven't done it yet. So until that happens, you have to look at that 480 level as a significant resistance and see if the market can indeed break above that level. Thought we'd look at the DIA. That kind of ran up and has been consolidating for over a month now. And we almost have, not quite, but almost an expanding triangle. As you know, triangles are normally contracting, where you have the wide part to the left and the thin part over to the right. So an expanding triangle is the opposite, where the point is on the left side and then the mouth is over to the right side. So we could get a bit of a break here on the DIA, but it's not much. Looking at 370 to 380, the high is below 380 and the low is above 370. So it's not a huge move on the Dow, but we could get a little bit of a breakout there. Even a break to the downside is not enough to get us down to where this wave four projection might be. We might maybe see a move down here towards 360 on the DIA if things continue to move to the downside, or a break to the upside could get us to the point where the shorts have to cover on the Dow as well, and we start to run up towards that wave five high. So interesting. You don't see a whole lot of expanding triangles, way more contracting triangles. I noted last year that we had a lot of expanding triangles, which was really unusual. Really used to seeing the contracting triangles and a few of these expanding triangles sprinkled in here and there. But last year we had a lot of them. And this is the first real one that I've noted of significance so far this year on the Dow. Looking at the Qs, of course, you want to look at the Qs when you have a day when rates are up. And believe it or not, early in the day, the NASDAQ was kind of up. It was the only market that was up. We finished slightly to the upside, well, slightly to the downside, actually, on the close, but ever so slightly. And just like the SPY, we're right at that resistance level from the December highs. Now, we haven't made it just high enough to move that wave three yet, so we haven't taken out the December highs yet, but we're right in that neighborhood. Clearly resistance there in that area on the Qs there around 410. And, you know, if rates, the market kind of shook that off today, at least on the NASDAQ with the tech stocks. Now they're talking about, so we went from Mag 7 to Lag 7, and now they're talking about, are we going to be back to Mag 7? Because earlier in the day, those top 7 stocks there, tech stocks were performing pretty well. They kind of succumbed towards the end of the trading day, but earlier in the day, they were up nicely. So, you know, the financial channels with their taglines are fascinating to listen to. You just kind of shake your head, and things that they hope will catch on and create viewers, etc. But right here around 410 is the key level on the Qs. Can we hold that? Get back above it? and then perhaps run up to that wave 5, or is that going to be a point of resistance to where we head lower? So if the question is, well, if we roll over, where do we go? Well, there's a lot of support here at 390 on the Qs. So again, with the SPY, I don't think it would be so bad if we came down towards 460. And then on the Qs, I don't think it'd be so bad if we came down to 390. I think all that is just healthy for the market, but those levels need to hold because they're significant support levels. So even if the market were to roll over and kind of feel a bit ugly, as long as those levels hold, I think we're okay. Looking at the IWM, which has been its own animal lately, kind of doing its own thing, down today. I feel like that is a bit of a signal of a risk on, risk off type of thing. And somebody asked me about that, like, what does that mean, risk on, risk off? So I thought I'd go ahead and talk about that for a second. The Russel's the small caps. And in general terms, risk on basically means you're willing to take risk in the market. So you're buying stocks. It doesn't even have to be in the small caps. It can be anywhere in the market, but you're willing to put money at risk. In other words, you're willing to get into the market. Risk off is when you're like, leave me in cash. I'd rather be in cash right now. I don't really want to be in equities. And so a lot of people look at the small caps for an early signal of what is the risk appetite? Because if you're willing to buy into the small caps, then the market in general normally has that risk on type of a mentality, like, okay, we're willing to take some risk. But anyway, back to the IWM, we're at a 40% correction, so right at the 38.2% level. We did fill this gap here that occurred back from the 13th of December. So a bit of a gap up, came back and filled it. And then we have this area here, potential support right there in the 190 level. We're right there. So the IWM needs to hold here. If it doesn't, then it could start to get a bit dicey on the Russell. If you break below here, there is some congestion in this area here around 185. You can see how we traded through that going all the way back to last summer. And so there's a corridor here between 185 and 190 where there's support. So is that why we had a doji on the SPY? Are we going to turn back to the upside tomorrow? Or is that a sign that this upward stuff is over and we're going to roll over from resistance? Well, we're not at resistance on the IWM, but we're at an area of potential support here between 185 and 190. I would say that 185 level is probably around a 50% correction. So I would be surprised if we break below this on the IWM, but if we do, we still have some support here at 180, and that 180 support level goes back a ways. So there's an area where we can find some support here on the IWM, and if we don't, then it starts to get really ugly. But anywhere in here between 180 and 190, if we can hold in this area, we still have a chance to move up towards that wave 5. What's it going to take now? Well, the market is pricing in that rate cut in March. That would certainly spur the market. It would surprise me. I don't believe that that's going to happen. I don't believe the Fed will cut in March, but I could be wrong. I'm wrong a lot. The Fed certainly shakes me a number of times with the moves that they make. But based on their own commentary, I just don't see the rate cut in March. Is that going to be a big negative to the market? Will the market sell off if we don't get that rate cut in March? All that's going to be interesting. That's down the road a ways, though, right? 6 weeks away. So we'll see how that all plays out. But we're in an area where we could find some support here on the IWM. If you're wanting to trade the IWM, I think this is an area where you wait and see the whole show me thing. If we were to break below 190, you would want to be back above it. As long as we can stay above 190, I think you can stay long. But do we break that tomorrow? Do we hold this level and break back to the upside tomorrow? That's going to be really interesting to see how it plays out. So as I'm wanting to say a lot, tomorrow is going to be an interesting day in the markets. And I know you're tired of hearing that, but that's what makes trading fun, at least from my standpoint. Somebody that's been doing it for 27 years, is it's always something to look forward to. It's always interesting. It's always something the time. Anytime somebody says that they've been around a while and they've seen it all, those are bad words when you say you've seen it all. Because as soon as you say that, the market's like, oh, yeah, you think so? Well, watch this. And so I say that I don't know if I dropped off a little bit there. It's telling me that I may have dropped off, but
You did, but it came back in. We didn't miss much.
okay. Good. Well, I've been around a while, and you're not going to ever hear me say that I've seen it all. I've seen a lot, but I'm never going to say I've seen it all because that's just tempting the market gods, right? So I'm not going to do that, and I'll never say that. So I've seen a lot, but constantly the markets are surprising me and doing the unexpected, which is one of the reasons that I rely on Elliott Wave so much. It's not 100% accurate, but having a good Elliott Wave software program, which this is called Profit Source from the Hub organization, HUBB.com. I know some of you from the market update have acquired the software and are singing its praises. And I think it's the best Elliott Wave software that exists on the market. I'm not a believer, even as good as Elliott Wave is, that you only want to rely on one single indicator. So the way I look at it is I look at Elliott Wave, but I want it backed by some of my favorite confirming indicators. That's my technical trading system. And that tends to work out pretty well. And I think that's a good methodology for everyone. I do think that no matter what your favorite technical indicator is, Elliott Wave can play a part in it. It's accurate so often that it needs to be part of your technical trading briefcase, if you will. And I've had some people also on YouTube that are saying, well, I've never really looked at Elliott Wave before, but now I'm finding it interesting. And that's that. I really like that when I hear that. Again, I'm not ever trying to say just rely on Elliott Wave and nothing else. But when you add that into whatever technical trading system that you feel comfortable in, I think that's a great thing. And I wouldn't sing its praises if I didn't believe it, because I'm going to trade with whatever I think is the best indicator out there. So I'm not going to be talking about Elliott Wave if I'm not a believer in it. So anyway, we'll see how this wave 4 plays out on the IWM. Let's look at a couple of the international markets real quick, and then we'll move on. We look at the EWA, kind of an ugly day there down under. Down here around that 23 level, which is an area that needs to hold on the EWA as well. Because look at this move here from 20.5 basically up to 23. We need to hold right there. And if we don't hold in that area, maybe we hold at 22 here. There is some support there going back to the end of the summer. That could perhaps hold. But if that doesn't, then we may be looking at those lows back from the end of October. So with this gap down here, we're probably a little bit oversold. There's the 10-day moving average, and we are oversold. We're trading right at the 50-day moving average. So you want the EWA, if you're trading the Aussie, to stay right in this area. This is a good area to find some support right in here. And if not, it's extremely important that it holds 22. And if it doesn't do that, then it gets pretty ugly from there. Not quite Katie bar the door again, Zach. We haven't had one yet. We've had a few that could be ugly moves, but we haven't had a Katie bar the door type of scenario yet.
I was ready on mic in case, but
yeah, we're oversold here on the EWA, so maybe that holds, and we'll see how it trades out from there. Looking at Germany, that market just had a heck of a run from the end of October. A little bit of a pullback today. We're at a 32% correction, which isn't really that significant yet. We're in the neighborhood of 38.2, so we could go a little bit lower. 28 has been a level that we've talked about on the EWG, going back to where it was resistance. Now it's support. That would bring us down probably in the 50% correction area. But we're just above the 50-day moving average. There is a doji there, so we'll see what that means for tomorrow's trade. Dojis, if you're not familiar, is when you have an open and a close that are extremely close to each other. So it makes like a plus sign or a cross-looking bar there. And that normally means indecision, like, okay, we sold off. Now what? Sometimes that can mean a reversal. In other words, we move back to the upside, or it can be more of a significant move to the downside. But usually when you see one of those dojis, something of significance happens within the next trading day or two. Looking at our friends up north, who are even colder than it is here in the Appalachians, are down here around 36, and they need to hold right here. Look at that area of support going back from April and May and July. And then we got up there in December, broke above it, came down and tested it. We're only at a 28% correction here. It did label the wave 4 because it went past 23.6, but just in an area here where I think we could maybe go a little bit lower. You don't want to see that though, because there is support here at 36, but there's a little bit more support down here around 35. Where that's an area of support. So that's the corridor there on the EWC between 35 and 36. If it breaks below 35, well, that may be our first one, Zach, because that would be a pretty significant move lower all the way down to around 32. That is kind of a Katie bar the door scenario there. There's just
Indeed.
nothing really to hold it if we break 35. So if you're trading the Canadian, you want to see that 36 hold. And if it doesn't, like, okay, well, I'll give it to 35, but that's got to hold. Otherwise, it starts to get pretty ugly. And then there was some commentary that I saw today throughout the financial networks on the INDA that says it's priced for perfection. And that may be true because it's had one heck of a run. If you go back to the lows of March, and you see that big run that we had, and then we went through a really solid consolidation for a few months. That's what you want to see. And then you take off on another run. That's good classic general technical trading there. Maybe a touch above a 45-degree angle move, but not much. We had a gap up yesterday, so we kind of brought that back down today. Based on that commentary, not surprising that we had a down day. We were a bit overbought after yesterday anyway. Coming back down towards that 10-day moving average, basically, we're still a tiny bit overbought, if anything. But if we start to break down, you see where the wave 4 projection is. And again, just for those that are new, that does not mean we're in a wave 4. That means if the wave 4 were to start, that's where you could expect some support to occur. That wave 3 can continue on. And as the wave 3 continues, then these projections on the 4 and 5 reset based on where the 3 goes. So if the 3 goes higher, that 4 will likely come up and the 5 will probably come up, but they'll change. But nonetheless, you just have to tip your hat to the run that the INDA, the Nifty, whatever, in the market over in India has done since those lows in last spring. Pretty darn good run there on the INDA. So if we take a look at our case study consideration from last week, it was on NVO, and I did actually send this out as an alert to our alert subscribers at ewotrader.com. So I really liked that one. And if you're not familiar with Ewo Trader, again, it's ewotrader.com is the website. And I'll give you an idea of what it looks like when we have an alert that goes out. But as I mentioned, that we had the one on NVO. You look here and you see this move. This is what we were looking at last week. And then if we bring it forward to now, not a whole lot has happened. We did have one up day that occurred after that. I had some people ask, well, why? Because a lot of people have gotten used to me sending out alerts on wave 3s because I love wave 3s. I love wave 3s that have zigzags in them. I think those are great. And then when you have the wave 5, it tends not to be quite as strong, but it can be just as long, if not longer, than the wave 3. The wave 3 is always the strongest wave. Often it's the longest one, but it doesn't have to be. The wave 5 can be longer, but it's not normally the strongest of the waves. So what we look for here when we see this extension is where is the DMI, and the DMI is still constructive. You can see the ADX is still between the two directional indicators. Now, granted, the positive directional indicators come down and the negative has gone up, and that's something to keep an eye on. If those two cross and make a significant cross, then you want to get out of the position. But at this point in time, it's not surprising with the fact that we kind of had an up day and then a down day and then call it two sideways days. So it's status quo basically to where we were last week. Not much has changed. And if we do start to move back to the upside, you could see that DMI reset itself and the ADX curl back higher. So it's something to watch, to keep an eye on, but it's not an area of concern yet. As far as technicals, you look at this level here at 105. We want the NVO to stay above 105. And as long as it does that, that's good support. And our target is not that high. It's just around 112 to 115 or so, just a little bit of an expansion here on this wave 5 move. So it's not a big move that we're really expecting. Just a little bit of an extension on the wave 5 based on a supportive DMI, at least for now. It doesn't look as good as it did last week, but it's still pretty solid. And we'll watch the next few days and see if this 105 level can hold. Now, I wanted to talk about the website. You can see here, every trade has one of these pages here. And here's one that we did. It's nice when they do this. They don't always do this. But on VEEV, you can see we had, call it a 50% move. And it says 0 days. And you're like, well, how can that be? The way this works is on a 24-hour clock. So what that means is the entry alert that was sent out on January 11th, and then the exit alert that was sent out on the 12th, the exit alert went out less than 24 hours from when the entry went out. So in less than 24 hours, we made a 50% gain. So when you look at the entry, it gives you all this information along with some reasoning and commentary and a chart, which a lot of people like. And you can see that the target price was just around 214. But then when we exited, you look at the exit chart and you say, well, you exited at 210. Why didn't you hang around until you got to 214? Well, we had those big up days. The stock rallied like crazy after we sent out the alert and then followed through the next day. And it got to the point where it was overbought. Now, when you have big bars like this, you get an IV infusion. A lot of people talk about the IV crush, but there's IV rushes as well when implied volatility actually moves into the options, and you can take advantage of that. And so if the stock goes sideways or pulls back a little bit, which is likely when it's overbought in this scenario, that extra IV goes away. And so the stock could kind of pull back and then drift back to the upside, make a higher price than we are here. But then the call options are worth less because they don't have that implied volatility infusion. So when you get an opportunity to take that, you're going to, and we're going to take a 50% gain in less than 24 hours pretty much every time. You know, nothing's 100%, but we're a high percentage of the time. If we can get 50% in less than a day, we're going to go ahead and take that. So you get all this information on every alert that goes out, the entry, the chart, the reasoning, what the exact position is here. It was a March 220 call, and the same exact stuff on the exit. So here on TradeFinder, we give you case study considerations, and then you're kind of on your own from there. So the difference at evotrader.com with the alert service is that we send you out alerts via SMS and or email on entries, any adjustments, and exits. So we kind of hold your hand through the process. That's the difference between the two. So I did want to share that with you. That was a great one. They don't all work out that well, but that one was a great one. And as you can see here on NVO, kind of a sideways move, but still constructive as long as we stay above 105. That's going to be the key level to see what happens from there. So let's see what we can find for a case study consideration for tonight. I'm going to open up the pre-computed scans here. And for those that are EWO alert subscribers and have this software, you actually get my searches. And the ones that say EWO on them, I'll bring it back here in a second. The ones that have EWO on them are my searches that are programmed in. So you actually can see exactly what I'm looking at on a daily basis. and follow along if you want to. A lot of times we have subscribers that ask, why'd you pick this one, etc. I saw this on the scan. And that's a great way to learn. So not only is it a great Elliott Wave tool, it's a great way to learn. So you can see there are three that are on the bullish search. So let's see what they are. Number one, that always, for those of you that have been watching for a while, you've heard me say this before, but when I see Google up there, I always get interested because over my time of trading Elliott Wave, and I've been trading Elliott Wave since 2001, long time, not my entire trading career, but a vast majority of it. Google's number one as far as the most trades that I've put on based on Elliott Wave patterns. It just tends to show up in Elliott Wave patterns over and over and over again. And you can see here the wave 5 is extended 72%. We take a look at this and we say, all right, we broke that resistance there just around 143. We've come down and we're testing that in this area. So this kind of goes along with what we're seeing in the market, where we had a nice run. We're at some area of support resistance, and can we move from here? Unlike the SPY, which is underneath resistance, Google is on top of support. So can it hold that area? And when we see that, then the next thing that I want to look at is the DMI. Is it constructive? Is it supportive of a continued move higher? And in this case, it is. You can see the ADX is making a nice move to the upside here. Even today, the positive directional indicator moved up and the negative moved down. That's a little bit different than what we just saw on NVO. So that's constructive. The level above 20 is slightly more aggressive than what you may read about. We have a lot of educational information on our website at evotrader.com, and we talk about these confirming indicators that I like to look at. All kinds of information there for you to peruse. I like when the ADX breaks above 20. Rather than 25, which is what you'll read a lot of times about the DMI. And that's because more often than not, way more often than not, if you see an ADX that looks like this, between the two directional indicators, so the whole DMI looks really constructive, you're going to get the ADX break 25 anyway. So it allows you to get in perhaps a little bit early. This one's pretty easy from a area of risk management. If we come down and break below 140, we can even give ourselves a little bit of room because Google, has a little bit of volatility on an intraday basis. So call it, as long as we stay above 140, you're bullish on Google. If it were to break below 140, then that's a whole different scenario. And then we have to likely bail out. But anything above 140, I think, is bullish on Google. So we're going to have a hard road to hoe here to try to beat those two. We also have Dollar General, which you could kind of make a case that might be interesting in a time if we do move into a recession. Perhaps the consumer backs off of spending, starts looking at more of the discounters for spending those consumer dollars. But right here, massive resistance at that same 140 level. So where it's support on Google, this resistance on Dollar General, this one's intriguing because we have this big gap that hasn't filled yet, and perhaps we're going to make a run up to fill that gap. 43%, call it the 38.2% wave 4 correction. But I would want to see a break above 140 first. So this is kind of one of those Missouri trades, I call it. Show me. Break above 140 with a follow-through day, and then perhaps Dollar General's going to 150. So I would want to see that one yet before making an entry. So it would go on a watch list, but not necessarily take action on it yet. And then we have Deckers. So we look at this and see this would be kind of more along the lines of the consumer still spending. If you take a look at the chart there, we did have a pullback, but we stayed in the wave 3. We didn't quite take out that high yet from the 19th of December, but we're awfully darn close. We have a new closing high, but not a new intraday high, just barely not. So let's see what the DMI is showing here. We had a really strong ADX there on this move, so it confirmed that this was very strong through that run there, and then a little bit of a pullback, which is expected after a big run like that. And it looks like the DMI is trying to reset again, but clearly you can see that it's not quite as good as the DMI was on Google. So of the three results here, Google looks really interesting. When we take a look at Dollar General, want to see a break above 140. And then when we look at Deckers, I would want to see it break that wave three high from December and allow that DMI perhaps to set up a little bit more. In other words, have the positive directional indicator move a little higher, the negative move a little bit lower, get a curl up in that ADX. It's trying to right now, you can see right here, but I would want to see just a little bit more there on the ADX. So that one would go on a watch list too. So I'd like to keep an eye on Dollar General and Deckers. But as far as the official case study consideration for tonight, it's going to be on Google. And it's not just because I prefer that stock. It's because that's the best of the three charts. So we're going to write down Google, and then I'm going to make a notation as long as it stays above 140. So your stop would be if a breaks below 140, you're out. But even a move down to 140 wouldn't scare us out. That would just be a test of support. So if it holds 140 and breaks up, then we're good to go. And if it breaks 140, then we're out. And well, we close at 144.08. So it's a 4-point move that we're giving it to wiggle around here, which would be a little bit of a loss if it were to break 140. But based on the chart, that's a good risk to reward standpoint. That's the kind of stuff that you look for, understanding you're not going to be right all the time. Those of you that have been watching TradeFinder for quite some time know that our history on these case study considerations is pretty extraordinary. But we haven't been right every time. We've had some that didn't work out, but the vast majority have. Going through and looking at the past, it's pretty impressive. So where would we expect this to go if we were to continue higher? Because what's the target price to the upside? We know where resistance is. So let's connect the dots here on this zigzag. So that would be the A wave. Here's the B. And we do have some resistance there at 150. But based on that DMI, if it was to follow through, and it looks like it's trying to, with that positive directional indicator going up and the negative going down, that's where you look to see if you get an extended move. And that means that you move past the expected target price to the next fib level. So the next fib level would be 164. So let's just round it down and say that our price target on Google is 160. So we would be looking for a move to the upside here on the goog, as a lot of people call it, from where we are now at 144 up towards 160 by the end of March. So let's give it, 2 to 3 months and see if we don't find Google up around 160. Certainly by then, we're going to know whether or not the Fed is serious about cutting rates. We'll know if we got that rate cut in March, which could certainly propel everything. If they actually do follow through and cut it March, that'll be, I think, a pretty good day in the markets across the board, unless we have a big run into it. I mean, if the expectation is that high that we have a big run into the March meeting, could potentially have a buy the rumor, sell the news, but we'd likely already be out anyway at that point in time. So that's going to be our case study consideration for tonight. Google support at 140, potential target around 160 at the end of March. So with that, Zach, 2 minutes early here. I'll turn it back to you here for any questions that the folks might have.
Yeah, well done on the timing there, sir. And Alphabet's always a fun chart, but data shows what the data shows, and it's definitely the three of the best candidates at the moment. So yeah, that'll be a fun
And
one.
it's in that whole AI space too, which seems to be coming back into vogue. There was a little market rotation there towards the end of the year and the beginning of this year, but it seems like interest is starting to pick up in those stocks again, save interest rates continuing to climb the way they did today. That could maybe put a little bit of a kibosh on it, but for now, it looks like there may be some money wanting to move back into those AI stocks.
Yes, indeed. And I just want to take a moment to remind everyone that's watching on the various live platforms to go ahead and hit that like button for us if you're enjoying the webinar so far. It does go a long way, so we greatly appreciate it. And with that, let's get into some questions here. Let's start out with Mara, M-A-R-A.
I figured that one was coming because we had looked at that either last week or might have been Thursday night in our insiders meeting. We do that every Thursday night for our alert subscribers only. They have their own meeting similar to this, but an expanded Q&A. We try to get to every single subscriber question on stocks. And when we look at this, it actually showed up on the sideways search that we have that's AI based. So AI is expecting this to stay in a trading range. I did not send that out as an alert, even though the AI reading was right on the cusp of what we look for. And the reason for that is it's it's a Bitcoin miner. So if Bitcoin takes off and runs again, this is probably going to do that as well. So even though the AI thinks that we're going to stay choppy, and it may prove to be right, I just feel like based on what this does, it might not be. So sideways, we could have another run like this with all that expectation of the halving in April. So that one made me a little bit nervous. And it was, just slightly below the level of the AI reading that we like to look for here. So I didn't send this one out, but for what it's worth, our AI, let me try that again. Our AI suggests this to move in a choppy movement, and the AI rating is based on one standard deviation, so it would stay in a one standard deviation range from here. We have, gosh, that wave 4 is right at the 61.8% level. So if it's going to hold, it should hold right in here. We're also in an area of support. So if you're long this stock already, you're right in the area where it needs to hold. If it makes it down to 15, I would say time to bail, because if it comes down there, it's probably coming down to 10. So it needs to hold right in here. And if we look at the 10-day moving average, we're a little bit oversold. We're trading just below, but right at the 50-day moving average. So again, if this stock is going to hold, it should hold right here. So if you have some real discretionary money that you just want to throw caution to the wind, you could take a shot here. But again, you would want to see that 15 level hold. And if it were to break 15, you got to get out. But anywhere from here to 15, I think you could take a wild shot on this one.
Very well. That's an interesting one as well. We're going to go over to a question from Antonio here on Zoom. We're looking at UNG with the weather over the weekend was expecting the opposite to today's price move down.
Me too.
Yep. And I third that.
Yeah, me too. Based on it, and from what I understand, there's another one coming. So you might see me in Florida sooner rather than later. But there was we kind of knew this though, right? I mean, we talked about it last week or the week before. There is a ton of resistance here at the 7 level. Look how long that was support. We're going all the way back to spring, where we traded back and forth and back and forth right through that 7 level. So to run up to it, get a little vertical, and then back off, even with the weather, is not surprising, really. So I said it surprised me, but when you look at the chart, it didn't really. You just thought that maybe that was enough to break above 7. But this is why I always talk about these vertical moves and why I don't like them, is when you get overbought and you're trying to break a major point of resistance or support on the way down, this is what happens. You just don't have enough energy or momentum left. So if we can kind of hold in this area here, maybe go sideways for a few days, and then try to break 7, maybe we can break above that level. And I submit that if we can break above 7, we might have something going on the UNG. But there's so much resistance there at 7, it's got to get above it first. And so to get turned back on the first attempt up here, I don't think is really surprising at all. I mean, the high of the day got in that neighborhood back on the 9th, and then the close on the 12th was right there. And so it backed off a bit. Again, nothing about that is surprising from a technical standpoint, but we don't want to see it go all the way back down to 5. We don't want to see that kind of a correction. If it does, then that probably means this run has run out of steam, and 7 was it. 7 was a hard ceiling, and we can't get above it. What we want to see is some backing and filling through here, kind of trade. If you're interested in this in UNG, you want to see a close above 7 with follow through. And then I think you've got something working here. There's a little resistance at 8, but we could really take off and run from that standpoint. And I wouldn't give up on it yet. That was a nice run up towards the 7 level. But for the next move, we've got to see a break above 7, and we don't want to see it give it all back and go back to 5. And then it's just kind of like it's over with, and we start all over again. So it's kind of important for UNG to hold in the 6 to 7 range. But yeah, that one was pretty in the last few trading days.
Pretty surprising indeed. And speaking of gnarly weather, I've heard those Cybertrucks haven't been holding up too well in the snow. Let's check out what's going on with Tesla.
Is that right? I hadn't heard that.
Well, I shouldn't say that as a blanket statement, but I've seen a few videos of Cybertrucks getting stuck.
Nah, yeah, that's not what Elon wants. But what I sit here, and of course, I'm sure everybody has seen the news. Now, look at the DMI; it looks awfully bearish. Now, for those of you that have watched for a while, know that I don't pay as much attention to the DMI on downward moves as I do on upward moves. Well, why is that? Well, downward moves tend to occur faster, and the DMI is a lagging indicator. So it normally takes a little while to set up. A downward move can do its whole thing and be ahead of the DMI on the downside. And the whole move can be over with just when you're seeing the DMI set up like, oh, that looks good to the downside. Well, yeah, that's too late. The move's already happened. So it is interesting that that's a that's a pretty constructive DMI to the downside. But with that aside, I tend to look more at the CCI, which is more of a indicator that moves on the day-to-day basis. So it's far more responsive to the day-to-day movements than the DMI is. And it's getting in the area of an extreme point low. You can see we did have a little tick up today as Tesla was able to finish off the lows that it had earlier in the trading day. And Elon's out saying he wants 25% control. I think he owns 13%, I think, maybe 14, but somewhere in the 13 to 14% of Tesla. But he feels like he wants more control over it. We called this one on the move from 240 to 220. We said if it broke 240, you're going to see 220. And if it breaks 220, then the next move is 200. It looked like maybe that's where we were heading today, but then it was able to turn itself around and actually finish to the upside on the close. And we were a little bit oversold. So I still think that 200 level may be in place. And I would think that if you could make it down to 200, that would be a good point to take a shot here on Tesla. I wouldn't want to do anything long until it got at least back above 240. So the aggressive move would be a break above 240. The more conservative, I usually try to give both an aggressive and conservative view because we all have different risk tolerances and you know what your own are. If you're a touch more on the conservative side, you want to actually see a break above 260. If you can get above 260, then Tesla's likely off and running. There could be a tradable move on a bounce from 200 up to 240 or from 240 to 260, either one. But I would feel more comfortable if we do make it down. It just seems like it wants to come down and test that 200 level. Now, just because it seems like it wants to do that doesn't mean it's going to. Let's see what the corrective level is at this point here on just this move. And we are, look at that, right at the 61.8% level. So perhaps it does try to hold here at 220. So maybe it can hold in this area. It's a pretty strong fib level. 61.8 is my favorite Fibonacci level. It's the strongest of all of them, in my opinion. So maybe it tries to hold here. And maybe this is more than just being a bit oversold short term. But getting that close to the 200 level I just feel like you got to be a little cautious on the potential there. However, that 61.8 level could very well hold, and perhaps we can turn and run back to the upside. But I still say that to even be aggressive on the long side, you got to get back above 240.
Very well. And so we've had a few questions around Boeing BA, and Jeff is wondering if this is a possible Katie bar the door situation.
I'm sure y'all saw the news on that, uh, whatever the number is, Max 9 or whatever, where the piece flew off, and they found some other aircraft with some loose bolts, and Boeing basically came out and said, "Yeah, we kind of messed up here." But you're getting to the point where I think a lot of the bad news is priced in. Now, the negative here is with that wave 4 at 87%, that Elliott Wave pattern has been disqualified and will go away here soon. So it's no longer in a 5 wave to the upside pattern here. But when you look at the CCI right here, we are down here in this area of extreme point lows. So Boeing tends to come down here, even when you go further back, the negative 200 level. And these levels on the CCI are interesting because it's not just a blanket level. All stocks have their own extreme point highs and lows. The general range is between negative 100 and positive 100. That's where the majority of the trading is. But each individual stock has its extreme point highs and lows. And for Boeing, the extreme point low seems to be negative 200, which is we're headed right back down there now. So perhaps this area here around 200 could act as support. So as far as the scenario on Katie bar the door, I kind of view it as the opposite, where we've had such a vertical move lower. We are oversold short term from where the 10-day moving average is, and we have some support in this range. Now, could it go to 180? Easily could go to 180. But I don't see it going lower than that. And so again, on the aggressive conservative front, I think if you're aggressive, you could take a long shot here to see if that 200 level can hold. If you're more conservative, you want to say, all right, well, let's give it a few days and see what happens with this 200 level. Do we indeed make it down to 180? Because if you do, if you make it down to 180, I think that would be a good entry to the long point. And as far as shorting it, right now, you're so oversold at this point. That would make me a little bit nervous. It's vertically down, it's gapped down twice, and we're well below the 10-day moving average. We're just too oversold to short this, in my opinion. Um, I wouldn't be surprised to see it churn around a bit and maybe drift down to 180. If it were to continue vertically down to 180, I think that'd be a great entry. I don't think that's going to happen, but if it does, that would be a really good entry, because if it continues in this kind of a fashion here, with this vertical nature of the move, and were to make it down to 180, it would be extremely oversold at that point in time. And it got a bit vertical on its way up, and this is what I talk about so often. What goes vertically up often comes vertically back down, and that's exactly what Boeing did. But it's in a pretty good area here. This corridor here between 200 and 220 has been an area that it's found support resistance in the past, and I think maybe it will there. So I'm not so much on the Katie bar the door scenario there on Boeing. I think a lot of the negativity is in there. They're going to get that fixed, and maybe it chops around a little bit. I'm not saying it's going to just turn around and run from here. So maybe it chops around in this area. But I'd be looking more for a long entry here rather than a short one.
Well, let's hope so, because we certainly don't want any nosedives with the Boeing. So that'll be
Oh
going
man,
too.
it's brutal.
Got to throw a little bit in there, right? Let's go over
Yep.
to um, for Emmanuel Affirm. Been breaking down since it got to the 52 range. Thoughts on shorting?
Yeah, and I had talked about this before. Here's another one that went pretty vertically to the upside, and there's been a lot of conversation about this and questions about this from our viewers. And if you were doing online Christmas shopping, you saw them everywhere. And so the run into the holiday season at the end of the year was not surprising at all. And so it's had a little bit of give back, which is normal after such a run like that. And I would submit to you it could potentially go lower. So the question regarding a short, we do have a doji today, so let's see how it plays out tomorrow first. It could hold in this 40 range. That wouldn't surprise me if that's all the give back that we get. But I think we need to get a little more information on the consumer. Um, and that's probably going to play into this. But it's what at 40.98 now, so you don't have to give it too much more room. A break below 40, and I do think you have a pretty good short here. But I would want to see that break of 40 first, especially with that doji. I want to see what happens tomorrow, but I would keep an eye on it. Even if it holds 40 and bounces, I would still watch this one and see if maybe it's a short-term bounce and then it turns and heads back to the downside. If we are going to head into a recession, you would think that, perhaps this might struggle a little bit. So I think you might be onto something there on the short one, but I just want to see a break below 40 first.
So we always go through coin and Bitcoin. Let's check out BITO for we'll switch up at first.
Okay, the ETF. I was going to look at the actual Bitcoin, then we'll look at the ETF.
Hey, you're the captain here, so you get the way.
So, yeah. There was a little buy the rumor, sell the news. So this is when the ETF started trading and we broke above 49,000 for the first time in a while. And then there's been some give back, but it's trying to hold right here where the point of this triangle was. And that's normally what happens with Elliott Wave corrective triangles is after the breakout, it comes back to test it. That's what's going on now. So can we hold in this area here around 42, 43,000 on Bitcoin? And the ETFs, they're coming to market at a pretty good time, I think. With the interest in Bitcoin, with the halving and everything else coming up. After that, I don't know. April could be a real true buy the rumor, sell the news event. So we chopped around a bit. We're back down here towards the 50-day moving average. We're holding right through here. At 19 really needs to hold on BITO. If it can hold there, I think you're good to go. You're still above the 50-day moving average. You got in the neighborhood of it and recovered with Bitcoin in today's trade. So if you're long this, as long as it stays above 19, I think you stay long. If it breaks below 19, then I think you get out and wait and see how low it goes and look for a better entry. But anything above 19, I think is good. This could just be a test of the 50-day moving average, and then we turn and head higher from here. It isn't a wave three, so we could, run all the way up towards that 27 area. And look where it's calling for it, 15th of April. So right in that same time frame that we've been talking about, which kind of makes sense. Market doesn't always make sense, but that part there kind of does.
All righty. Thanks, Rob. I see we're 3 minutes after the hour. You got time for maybe one or two more?
Yep, go ahead. We'll do two more and then we'll call it a night.
Let's check out UEC, uranium for Constantine.
Um, yeah, we haven't looked at uranium in a while. Gosh, I see why you want to look at it, Constantine. Holy cow. But I don't like that. Constantine's been here enough to know I don't like the stuff that goes vertical like that.
Yeah, and I actually saw some commentary in the chat saying the principle is understood, but the question is when. And I think if we had that answer, we'd all be in pretty good shape.
Yeah, well, we did have a bit of an ascending triangle here, and gosh, you could almost draw it all the way back to the lows in September because it's just a steady movement of higher lows here, and then it was bumping its head against 7 for a while, And so not shocking that breaking, triangles break out three ways. One of them is this way, or it makes a vertical move. Other times it breaks out, comes back and tests it, and then moves. And then other times it'll just break out and go at a 45-degree angle. So this is the vertical breakout. It's way too overbought now. I don't know that we come back to 7, but I think that it needs to kind of churn here a bit. We can look back and it has another one of those big spikes and say you missed it. And for me personally, I'm willing to miss those because more often than not, when I see this, you get a pretty decent give back. So here, um, I think maybe some backing and filling is warranted, perhaps filling this gap. Don't know that we come all the way back down to 7, because that's a pretty pronounced break of resistance there at 7. So I don't know that we come back down there yet, but I wouldn't be surprised to see a bit of a lower price. And I think closing that gap, what was the high? 783. So if you get something in the 780, 775 area, I think that would be a pretty good entry. And if I was long it now, I would have taken it off today on that second spike because it's just too vertical. But if I'm holding it now, I'll give it that room down to 775, see if it holds that and can catch itself and then maybe turn and move higher. But if I'm looking for an entry, I would also wait for that area around 775 or so to enter.
Well, excellent analysis there, Rob. I thought that was a fantastic presentation, and we're getting a lot of positive feedback in the chat as well to second that. So we'll wrap up this session with BHP, and just want to thank you all again for attending live. Look forward to seeing you all next time.
EHP,
BHP.
BHP. Okay. Yeah, thanks everybody for ending your evening with us. We do respect your time. We know time is extremely valuable to all of us, and we do our best to make your use of time here as informative and educational as we possibly can. The wave 4 here is right at the 61.8% level. It's going to try to hold here. And if I go back and look, there's some pretty good support in this range between 60 and 61 as well. Even if it can't hold right here, it's got a little bit of a layer lower. So, if you're trying to find something in this space to jump into, this could be it. Again, an aggressive move, I think, is anything above 60 you take a shot at and see if you can at least get a tradable bounce. If you're more conservative, then you want to see a close here above this area right around 63. So you want to get it up, fill this gap, get above the 50-day moving average. We'll be back to the 10-day moving average by then. So an aggressive move would be taking a shot anywhere here down to 60. And the more conservative trade is I'm just going to wait and let it break above 63. Then I'll go long. So pretty interesting one there. And another one, vertically up, vertically back down. And this, I mean, it doesn't get much cleaner than that. A vertical move up and really a duplicate vertical move right back down. So the rules that we talk about so often here play out over and over. And these aren't stocks we've picked. These are stocks y'all picked. And we're still finding the rules to apply. So I think that's pretty important there. So as Zach said, thank you so much for spending your evening with us, and hope you have a great rest of your week. And we look forward to talking to you again next week.